Welcome, everyone, to another episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Thursday, May 22nd, currently 4:02 p.m. to put a timestamp on it. So, we are doing another Investment Friday episode with my good friend, Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. We're going to talk about a couple of things today, but as a teaser, we're going to talk about, is this the next Great Depression or not, and why? So there's our tee up for today. How you doing, Brad?
Great. But that sounds super depressing.
I know, I know. I said it with enough enthusiasm so that people would stay
Yes.
because it's interesting. It's interesting stuff.
It
Um,
is very interesting.
but we had some, just to dive right into it, so we make sure we have enough time. We had some interesting news at the beginning of this week with the downgrade from Moody's on the U.S. credit rating. So tell us what that means in case people have, seen that headline and were worried about it.
Okay. So let me talk a little about the credit rating agencies. Okay. They seem like the word agency seems like they're an official entity, and they are, but they're private businesses. So what they do is they essentially do financial analysis on different government entities, different, the U.S. federal government, all the way down to your local and state governments, school districts. I mean, they do a lot of really deep diving in terms of revenue streams, expenses, and expense trends. And then what they do is they assign, based on those characteristics, those financial characteristics, they assign a rating based on the safety of those incomes and revenues and expenses. So, effectively, what they came out to say this week was Moody's, which is one of the top three or four credit agencies, came out and said, hey, based on the potential for the tax cut, or making permanent basically the tax cut we've had since 2017, um, in addition to the expense problem we have in the United States federal government, where we spend, in addition to the amount of money we have coming in, we spend an extra 2 trillion a year. So not a small dollar amount, a very large dollar amount. They said, based on these trends, we're going to have to downgrade from the top tier, so the AAA rated, which is the safest out there in the world. We're going to have to downgrade it to the next notch down. Now, what does it really, really mean? Um, Now, to give you an idea, Moody's did it this week. Standard and Poor's, which is another credit agency that competes with Moody's, they downgraded the U.S. Treasury debt. They downgraded it in the 2011,
Mm-hmm.
so a while ago. Okay, and it that downgrading hasn't necessarily hurt the US government from funding any of their deficits since that time, right? And in fact, we've had among the lowest interest rates on our debt since that time. But what it does do is it does highlight that we have an expense problem in the United States with the federal government, that something needs to be done, i.e., either revenues need to go up or expenses need to go down, or a combination of one of those two options. Um, and again, it just brought to bear the fact that, um, excuse me, for some reason my computer decides to turn off my video without me even doing anything. So I
You're
apologize
back.
to our viewers on that. If you're listening, it doesn't impact you at all, but for some reason, my camera just decides to turn off. So that's fun. I'm going to plug in these a little bit more in depth. So what it does is it just highlights that need for Congress to kind of get on the stick and put together a bill that cuts our expenses, increases our revenues, again, or a combination of the two, so that we can solidify our financial rating, strengthen our balance sheet and income statements, and allow us to do that. Now, practically speaking, it doesn't really matter that much. Okay. And the reason why is because we have the reserve currency in the world for the United States. The US dollar is the reserve currency. What that means is most business transactions around the globe are done in the US dollar. Okay. Which means there's always a demand for US dollars to pay your bills or to have your incoming revenue in US dollars. So there's always a need to transact in the US dollar, which means it'll always have somewhat of a value. Now, if we get to the point in the US where the rule of law becomes more suspicious or it becomes a little more flimsy, where foreign investors can't or investors in general won't believe the US government when they say they're not going to default. Okay.
Mm,
If that starts to creep in, which it seemingly has started to come to pass a little bit, um, that will call into question the US government's ability to fund their deficits by taking in money from other investors. Um, if that happens, then what we have is the yields on US treasuries will go up, i.e., prices of the existing bonds go down. Okay. And it will become much more expensive to finance our deficits going forward.
hmm
And if that happens, that puts us in a very precarious position, or it could put us into a precarious position um, from that standpoint. Again, that's a ways out, and it really depends on what the U.S. government, puts out there in terms of propaganda or narrative to. Um, Holy mackerel! I apologize, stupid camera.
All good. Don't worry about it.
So okay, so again, practically speaking, kind of a non-event. Started in 2011. The last major agency to downgrade the U.S. was this week, and I don't think it's going to have that much of an impact on the markets. So
Well, that's good to know. Um, because yeah, when I heard that news, I thought it was maybe another downgrade because I remembered, I recalled specifically that we had heard similar news before a long time ago, and then when you confirmed it was back in 2011, um, it seemed like it was a little bit more of a shocker back then. I
oh,
remember everyone feeling more surprised when that happened.
for sure, for sure. I mean, back then, I mean, I remember when it happened. Back then, people were um, there was a lot of talk about the acrimony coming into the political process. If you
Hmm.
remember, this was during Obama's first administration, and the acrimony between was really starting to ramp up between Republicans and Democrats.
Hmm.
And um, to Obama's detriment and to the U.S. detriment, Obama really pilloried um, the banking industry for doing what they did, which was essentially lend subprime, do a lot of
Right.
subprime mortgages because the federal government via Fannie Mae and Freddie Mac were asking them to do so. Okay.
Right.
And so that acrimony started and has only accelerated since that time. And so because of that acrimony is why S&P downgraded us. So back in 2011. So again, not a great thing. So what credit rating are we? Okay, so AAA is the highest. He goes AAA, double A, single A, and then we don't want to talk about anything below that because that's nowhere that the U.S. government will ever be. But right now with Moody's, we are a double A1, so AA1, which is the highest rating outside of the AAA.
Okay.
Standard and Poor's has rated us a double A plus, which is again just one notch below triple A. So it's not like these credit agencies are saying, "Hey, we're in a world of hurt." That's not what
Hmm.
they're saying. They're just saying there are more risk than it was at triple A. And
Okay.
there are other entities and governments that are AAA rated still. So not very many, but there are a few. Um,
Well, we
so
will, yeah, we'll watch the bond markets then, because that's more where we see the movement from that announcement is in the bond
right.
markets in general.
Yeah,
Yeah,
and if yields start to move based on the US Treasury, okay, which they could because the amount of supply, basically the US Treasury issuing so many bonds and notes and bills, we need to fund our deficit of $2 trillion. That supply, that more higher supply of bonds with a similar amount of demand implies higher yields in the future. There's
mm,
just kind of no way around it because we're issuing so much debt that, I mean, 2 trillion is a lot of money. So, I mean,
right.
we are soaking up. What that does is it goes to all these countries around the world and says, hey, we're going to try to soak up your excess savings. So give it to us, and we're essentially a bond market saying we're going to give you a competitive yield on our very, very safe US federal debt. Okay. And essentially that's what's been happening for about 30, 40, 50 years. So
Yep. I saw that mortgage rates ticked up a little bit this week, which is very closely tied to the 10-year treasury yield. I believe is what that
yep,
kind of tracks. So yeah, I mean it's affecting, it will affect people in, in the streets, as they say.
100%.
But we'll just pay attention, see what else comes from that, if anything. Hopefully nothing. But our little history lesson there, I feel like we could do one on that as well. Kind of the fallout from Dodd-Frank and all of those different things that really went down because of the Great Recession and all of the regulations that were put into place that have been, people have been kind of pushing back against since then. But we're going to go way back.
You're going way back.
We're going way back this time because there have been a lot of people saying, are we closing in on or comparing, making different comparisons to today and the Great Depression and the Roaring Twenties before that. And there are some very interesting correlations or echoes of the past, of just what do I want to say, how disparate the income is, how our income gap is very high right now between the top 1% and the 99% of everyone else in the United States. We have some of these similar things happening that were happening back then. But like we've said a lot, history rhymes, but it doesn't repeat exactly. And the financial systems in particular have gone through so much change, have been put through so many layers of regulation over the last 100 years, especially, that we're in a very different landscape. Even though we do, like, I will absolutely agree that there are things that are rhyming and echoing very strongly right now. So, how can we understand, how can we put into context what happened during the Great Depression and what are the similarities and what are the differences? That's what we're going to kind of dig into.
Absolutely. I mean, to set the stage, we do have to go back even further than the Great Depression because really World War I set the stage for the Great Depression. And so, I mean, if you put yourself back into to 1918, early 1920s in the United States, um, World War I was happening all across Europe. Okay. And so during that time, the United States farmer specifically, but also manufacturers of industrial products, were told to increase production, right? So I'm going to use the farmer as an example. Um, Obviously, European farming was very difficult at best, if not impossible to do. So that entire agriculture output for the globe went to basically zero because of the war. And so you had the American farmer stepping up to fill that void, to produce the food that we could then send to Europe, both for the armies of the Allies, but also to produce food for everyone else that was going to miss out in the civilian world. Um, so that sets the stage. Now, to expand the production, a lot of farmers, a lot of businesses had to go to the banks and get debt to acquire more land, to acquire the seeds, the fertilizer, the equipment, and to produce more food. Okay. And again, this applies to businesses of industrial products just as much as it does to the farmer. But I think the farmer is a telling case, and it's a very good analogy as what happened across the U.S. economy. So we go through the war, production skyrockets. We go through the war stops. World War I is over. It ceases to exist because Germany lost. Okay. So lots of things politically happened, but one of the things that happened is all the men came home,
Hmm.
okay, from World War I, and you had U.S. farmers still producing a massive amount of farm goods. Well, the difference is now the demand is much lower because you have the supply in Europe coming back online. Well, in the US, we didn't moderate that production. We didn't decrease our production because what happened was a lot of these farmers were indebted, so they had to produce much, much more. Similar with businesses. If you were making a industrial product, you were in debt to expand your factory. Well, just because the war is over doesn't mean your debt's gone away unless
Right.
you've paid it off in some way, when most didn't. So now you have a very quickly changing demand and supply dynamic for a lot of goods around the world. So what happened is when the US kept the same amount of production in the farmland and in industrial products, what happens to the price? They go down, right? You have a surplus of goods, boom, all of a sudden prices come down. To that point, wheat was down 70%
Whoa.
in 3 years. Um, Hold on, I wrote this down. Yeah. So wheat, cotton, and corn were down 65 to 70% in that time frame.
Wow.
So it collapsed a lot. So we had in that area, we had deflation. Okay. So deflation on a highly indebted, highly productive, high inventory caused some stress in the banking industry that had lent to those farmers and companies. Okay. Well, same time frame, you had people in the equity markets. It was a great time. I mean, the stocks had really rock and rolled. And the cool thing about it was the margin rules at the time were is you had to put 10 to 20% down for a
Oh, wow.
purchase of stock.
So you could
So
lever 80 to 90%.
correct. So what
Wow.
would happen is you would say on $100 stock, you would put $10 down and the bank or the brokerage company would lend you 90. Okay. Which
Hmm.
is fantastic when the market's going up, right? Because all of a sudden, if it goes up 10%, you basically doubled your return on equity because you started with 10 and you ended with 20. So you're up 100%. So it's one of those things that is very, very highly levered. Okay. So that was on individual stock. Additionally, at that time in the marketplace, broker dealers and investment banks have started creating investment trusts, which were the precursors to mutual funds.
Mm.
The difference is these investment trusts were levered. Okay.
Leverage everywhere.
Let me describe how these were levered and how crooked these were. But they have semblance to what happened in 2008, 2009. And I'll draw that corollary. So essentially, you and I would set up an investment trust A. Okay. We would go out and we would sell preferred stock to these investors. So, for those of you who don't know, preferred stock is their stock, like equities, on the market, but instead of going up and down with the earnings of the company, it pays you a coupon. It pays you a stated rate of dividend. And
Mm.
it's usually pretty high, 5, 6, 7, 8%. Okay. So we would go out and we would sell these preferred shares to these investors. We would then get a loan from the bank to add to that, to augment. So now we're a levered investment. We would invest in stock, okay? But instead of investing directly in stock, what we would do, we would take that money and we would invest in Trust B. Now, Trust B would also go to the bank and say, "Hey, Bank B, we want to get, a 60% loan on the value of these assets we have." So Bank B would go, "Fantastic, here you go. You're only borrowing 60 on 100, so that's great." So they would loan. And then Bank Trust B would invest all in Trust C.
Yikes.
Trust C would do the same thing. And then Trust C would own a lot of Trust A. So let's talk about what we actually own. You own nothing, because what happens is there's a little bit of common stock in there that when it goes up a lot. But the problem is you have this circular ownership and this leverage at every layer.
Mm-hmm.
And it becomes what we call a pyramid. Not a pyramid scheme, so I want to stay away from that. But the returns were then pyramided in
Mm.
the sense that if Trust C went up, Trust A went up a lot because
Okay.
of the embedded leverage in Trust B, Trust C, and Trust A. So it was it it's always, they were great trusts until they weren't, right? But it's because of that scaffolding effect of leverage that made it a very, very vulnerable investment to any market downturn.
Right, right. Because if you owe 90 $90 on your $10 gain, but lose it and it all goes away, you still owe $90,
Correct.
even if you have $0.
Correct.
And
It
that's,
doesn't go away.
yeah,
So what happened was we had banks starting to get real wobbly because of the manufacturers and the farmers who were then being stressed. So the banks started to get stressed. Well, that put more stress on the equity market, right? So we had Black Monday and Tuesday, which were October 28th and 29th of 1929,
mm,
which essentially in 2 days they were down roughly 25%. Okay. So a 2 day 25% decline. And now this was the Dow Jones Industrial Average, because at the time that was the only market index that covered everything, covered, you know, 30 stocks was a big deal back then. Um, so it came down 25%. Well, what that did is that put a lot of banks in financial distress, major amounts of distress. And we have to remember, this was before there were no FDIC safety nets.
right.
So what happened is between 1932 and 1929 and 1933, you had 9,000 banks go bankrupt, shut their doors, because people got worried,
Hmm.
because there was no safety net for the banking institution. So all of a sudden, banking depositors started going and getting all their deposits out as much as they could. And that's what we call a run on the bank, when depositors go in all in mass and pull out their deposits. Well,
Right.
that causes a bank to go bankrupt that fast. So that happens. So the shaking of consumer confidence shuttered about 9,000 banks. Now, to give you an idea, that's about 20% of the banking industry at the US at the time,
That's
over a
so many.
3-year period. That's a lot.
Yeah.
And it accelerated. So within those 3 years, there were three separate banking crises that happened, all related to these debts that they were that the banks were no longer able to collect on. One, from the equity market, because stock market came down and a lot of those people went bust. And then two, because farms and companies were going under because they could not fund their debts any longer because of the lower prices. Um, at the same time, we had international trade. In 1930, we had the Smoot-Hawley Tariff Act, which increased tariffs by 20. It increased the average tariff from 40% to 60%.
Wow.
So, right now, today, as we sit here with the Trump tariffs, um, as we sit here today, the average tariff with those tariffs applied are about 14, 15%. Okay. And again, I'm including the China pause. So it's about 14, 15% on average. If China goes up, then that average tariff goes up a lot because they are an enormous trading partner for us. But right now it's about 14, 15%. That's up from 2.5 roughly in 2024.
Wow.
So it's a big increase, but it's not nearly going from 40 to 60% average tariff. So that's a big
Right.
difference in terms of trade. Now, just the tariff and the retaliatory tariffs applied by foreign countries caused global trade to shrink by 60% in 2 years.
That is insane.
Yeah, that's a lot. That's a lot. Um, so, a couple things that happened. So while we're going through this, I want you to have the understanding um, that the government did a couple things that were really very poorly planned. One was applying the Smoot-Hawley tariffs at the time they did. Okay, it may have been okay at another time, but right in 1930, you were right about in the middle of the Depression, and that was a terrible time to try to increase tariffs. Okay,
Right.
because it really cramped it. It really took an economy that was already struggling and plunged it further into struggling. And then you had the Federal Reserve, which again, the Federal Reserve was trying to figure out their place in the world and who they were and what they were supposed to be doing for the US government. And so they made a couple of very large mistakes. I'll give you an example. 1928-29, they jacked up interest rates pretty good, which is a lot of historians believe was the trigger that caused the equity market to collapse.
Wow. Okay.
Okay. So 1928, 1929 increases interest rates a lot, makes margin less affordable. All of a sudden, stocks start to struggle, and you have again, that leverage takes over and exacerbating downtrend. And then in 1929, 1930, when they saw that the economy was struggling a lot, banks were going out of business, they didn't do anything. They had a
Huh.
small interest rate decrease during that time, but they did not add any liquidity to the banking system at all. Okay. So that again, if you didn't support the banks, they were going to continue to go under, which 1933, a lot of them, like 1,700 went bankrupt. So it was a pretty bad year. And then in 1930 through 1933, again, I mentioned there was three banking panics because of all those reasons. They were not, the Fed refused to be the lender of last resort. Now, for those who aren't as familiar with that term means, the lender of last resort is when things start to hit the fan in the financial markets, both in the bond market and equity market, particularly with the banking sector, the Fed will step in to support that industry. It
Hmm.
will infuse a lot of liquidity in the system so that financial transactions can take place. The banks are going to be they're not going to go under. So when you make a transaction, if a bank's on the other side of it, you're not concerned if you're going to get paid or not.
Right.
Um, so so that lender of last resort boosts confidence in those banks. But they refused to do that in 1930 to 1933, which again caused another big wave of bankruptcies. At the same time, I'll give you an idea. Uh, because of those actions and the way they came about during the Great Depression, it exacerbated the Great Depression significantly. You had the money supply shrink by one third.
And the
So,
money supply is the cash that's flowing through the economy, basically.
yep, it's all the cash transactions that are checks and all of those things, CDs, all of the money that's available to be used for economic transactions. Okay. So if it goes down by a third, that's not good. And that means we're in the midst of deflation. It means everyone's a lot poorer.
Yeah.
Okay. Uh, we were in the midst of a massive deflationary problem because of excess production. In 1933, we left the gold standard,
Mm,
which allowed us as the Federal Reserve to do some more loosening of the grip on gold, just to make sure that, because the gold standard was supposed to give confidence to consumers that their money was backed by something of real value, i.e., gold. Okay.
hmm.
But it constrained what the Federal Reserve could do because it had to be backed by gold.
Right.
Well, the Federal Reserve, part of the reason is in the midst of the Great Depression, they increased interest rates in the midst of the Great Depression was because they had to defend that gold. Well, once they left the gold standard, the New Deal was brought about, then things started to get solved. Additionally, the bank failure problem really caused what we call the Banking Act of 1933. And this was, I believe, the single strongest legislation to help the United States come out of the Great Depression. And that was it created the Federal Deposit Insurance Company.
Mm,
Okay. So it started to give insurance on depositors up to a certain amount, right? It said the federal government was going to insure your deposits up to a certain amount. And so it brought consumer confidence back into the banking sector because people were like, hey, if the federal government's going to back it, then I'm okay with that. All right.
right.
Now, bear in mind, it didn't solve all those problems. And we all know people, whether it's our grandparents, our great grandparents, great aunts and uncles, who still kept an enormous amount of cash at their house
Right.
because they were fearful.
Right. They didn't trust the banks.
No, they didn't trust the banks. And it became that became the biggest single problem going forward and how long it took the US to recover uh from the Great Depression. World War II helped that enormously. The New Deal helped that enormously. Um, but again, there that psychological trauma for people who actually went through the Great Depression, it never really went away in their
Right.
minds, even if they did use banking in the future. Now, can this happen today? What are the corollaries with today? Well, there's a lot of similarities as you were talking about. There's an extreme amount of rich versus poor in terms of incomes um, and in wealth, right?
Hmm.
The wealth of basically the wealth effect is huge still, the disparity between the richest and the poorest. Um, and it seems to get worse over time, not better. So that's one similarity. Um, However, let me point out the things that are very different than they are today. One, you can't get levered on equities as much as you want. Um,
Right.
I think we saw a little bit of that during 2008, 2009, the Great Recession, where people would take out of home equity loans and put it in the stock market. So,
I was just gonna
yeah,
say that because tongue in cheek had I did not recommend this. Just to be super clear, Jack, if you're listening, our compliance officer, at a conversation with clients, and they were, we were talking about, that they're still saving into the market, they're doing a good job, And I was like, this is the best time when things are volatile to keep, if you have money to put in, to continue to save into your 401k, save into your IRA, right? Like all the things we talk about. And one of them said, oh, so like, does that mean like I should take out a 0% credit card and then throw that in the market? And I was like, absolutely hell no, that I cannot, literally cannot ever recommend that to you because it is goes against every prudent investor standard that I have to be held to as a CFP. But also, that's a really, really bad idea.
Yeah.
And that's the thing, then that's 100% levered for you individually, right?
Yeah.
If you take $10,000 off of a credit card and put that into the market and your investment drops to zero or $1,000 or $1,500, you still have to pay back $10,000 to the bank. They don't care at all what you did
Yep.
with the money. And so the same with a home equity line of credit. And so that's
Yep.
what you're saying there too, is like we were in a bubble of, and this also echoes back to the 1920s, right? We were in this bubble of this bull market just won't stop. You
Yeah.
just have to keep getting in, keep pouring money in.
Let me give you a couple similarities to that time from some of the newspapers. Some of the newspapers in the 1920s were very reminiscent of the 2007 to 2006, 7, 8, 9 period. The newspapers, magazines were advertising investments that you could get rich really quick.
Hmm.
Okay. Now it's tempered today, but you still hear it. You still hear in the narrative, these stocks that are going up so fast, and these kids that everybody's getting involved. Um, we have levered vehicles. Okay, we do. Not as levered as perhaps the investment trusts of the 1920s, nor the collateralized loan obligations in 2007 to 2009. Okay, but we still have leverage that people can gain access to, just like the home equity loan, right? You can go do that. Not smart, but people do it. You had
Mm.
record volumes, and a lot of those volumes were unsophisticated retail investors who were driving a lot of the trading volume. Okay. And they
Hmm.
were trading short term. They weren't necessarily um, buying for the long term. And that is where there's a book called Reminiscences of a Stock Operator, which is one of the classics in our industry, which talks about an individual who essentially quits his job and starts trading as a day trader,
Hmm.
essentially. Um, and so you had a lot of that in the zeitgeist, where it was like, oh, you could get rich easily in a short-term trading pattern. You can trade today, it's zero dated options, call options, where you have like a day or two left. You can make so much money on those.
Right.
So that's very, very similar. Okay. Another similarity is in 1924 to 19 through 1929, the equity market quintupled.
Wow.
Okay, so just to bear that in mind, it quintupled. So we're not there yet. We're not there. We have not quintupled. We've had really good returns on the US large cap, less so on mid cap, small cap, international, and emerging market. But large cap US, giant cap, mega, Mag 8, we've done very, very well on. Okay. So those are similarities. All right. What are the differences?
Hmm.
The differences are this. One, we had the Banking Act of 1933, which creates the FDIC. Okay. You have regulations on banks holding companies, on banks, on what assets they can buy to fund their balance sheet. We have regulations on how much they need to keep in reserves. Okay. And those reserves have been, ever since 2009, have ramped up significantly. In fact, right now, the banking industry in the US is probably the safest it's been in decades because of those reserves are much higher.
Oh, yeah. And I wanted to mention there, when we talk about the run on the banks back in the 30s, that, collapsing banks really quickly, that's because banks they don't keep enough dollars on hand for every person who has an account there to take all of their money out in the same day or the same week. They literally don't have that much cash in the safe. Um, and even today, banks aren't required to have 100% of their deposits on hand. So there's literally no way for everybody that banks at a certain bank to take their money out all at the same time. But it is a lot better, right? That's what you're saying. Their balance sheets are much, much healthier now than they were back in 1929, 1930, 1931, because they had to keep even less on hand. They could lend out more with little on hand. And then, yeah, when, 1,000 people or even 100 people come knocking at your door wanting all their money, you're like, that's it. That's all the money. We don't have any more money.
Exactly. So it's really quick to run out.
Right.
So
It's that
it,
simple. It's not complicated. It's
no,
pretty simple.
no, it's really simple. It's why, so I'll give you an idea, you know, well, I don't want to tell you the numbers, but it's just the US banking industry in general right now is very safe relative to what it has been in the past. We
Hmm.
regulate what they buy, we on their balance sheet, we regulate how much they need to keep in reserves. We have FDIC to backstop the depositors. So for the general rule, depositors are generally safe. Um, Even in the banking collapses of the last couple of years, where you had Silicon Valley Bank and you've had a couple of banks go bankrupt, you'll notice FDIC steps in, backstops the depositors, and then sells that bank very quickly, transitions that bank to another bank that can then kind of clean up the situation. And then FDIC works with that buying bank to help clean up that problem institution. So again, those things were not in place. Also, different Federal Reserve and almost everything about the Federal Reserve is different today than it was then. Today, they give forward guidance on what they're thinking. They can use both both the interest rate and reserve requirements to change to increase liquidity versus decrease liquidity. Very importantly, during a stressful time, they have acted in the past now as the lender of last resort. Again, they help backstop the banking industry. One of the great examples of this was during COVID,
Right. I
right?
was
During
going
the
to bring up that one.
spring of COVID, we were within the risk. We were within a day or two of going into a liquidity crisis where the liquidity in the financial system dried up. Okay. Well, the Federal Reserve stepped in and forced a lot of liquidity in the system. When they did that, the financial markets, both bond markets, credit markets, equity markets, all of those can take place now because there's excess liquidity. And they continue to put that liquidity to work and in the system. We hear a lot about the central bank's balance sheet. Well, yeah, that was quantitative easing.
Hmm.
They increased their balance sheet because the US economy needed that kind of liquidity in place to make it function. All
Right.
right. And then ever and when it wasn't needed anymore, in fact, it was probably needed much less. They could have started to cut much earlier. They decided to start taking that out in the terms of quantitative tightening, where they would take liquidity out of the system and shrink their balance sheet, which they've shrunk quite a bit um, since 2021, 22. Um, Also, you have again unconventional tools. I just mentioned quantitative easing and tightening. That's an unconventional tool that the Federal Reserve can use to help manage and blunt that damaging downside. Um, so, all in short, I would say, can we have difficult times in the financial markets due to leverage, due to um, speculation, due to a difficult underlying economic environment? Absolutely. We can, but those are all what I would consider normal circumstances of the business cycle. Okay.
Hmm.
Um, do I think we could get to the point where we have a Great Depression where unemployment goes to 25%, where You have global trade get cut by two-thirds, where you had prices of goods down 65%, where the equity market's down 90% peak to trough. It, I'm not going to say it never happened, but I think it would be much, much more difficult and a much smaller probability now because we manage the economy in a much more tight way than we did in the 1920s.
Hmm.
I'll give you an example, simple example, margin. Let's say
Yep.
you're a risk tolerant investor and you want to use margin to amplify your equity market returns. Fantastic. The most you can get is 50%. You have to put
Right.
half down and you can borrow another 50% to buy your security, to buy your stock. Okay. Well, when it goes down to 30% equity, okay, let's say it pulls back, it goes to 30% equity. That broker dealer will sell out of that stock for you and you'll owe the difference.
Hmm.
Okay. And it's automatic. It's not like margin desks on the investment banks, broker dealers are waiting for that to happen because you've signed the agreement, the margin agreement, and in it says if it goes below 30% on in general, that broker dealer now owns that stock. They can sell it to recoup that, and they'll bill you the difference. So again, the amplifying effect of margin is very, very low compared to, in fact, I think today it's like 2 to 3% on average is the amount of margin in the equity markets.
Wow. It's not very much.
No, it's
Less than
not.
I thought.
Yeah. Well, to give you an idea, um, back in 1929 when it popped, okay, um, margin was only 10% of the market value. Okay. I thought it'd be much higher, but it was $8.5 billion, $9 billion on a $90 billion market. Well, because it was funded in these other ways, like in buying these investment trusts, and it was in short-term speculative stuff, that cascading effect of leverage really, when it went down 10, 11% in one day, the next day it went down 13, 14%. That was enough to cause the dramatic fall off. And then there was some real economic damage um, on the banking sector, which continued to exacerbate it all the way down to 90% at its low. Um,
So what I'm hearing, um, and actually another example came to mind, a more recent example of um, leverage and speculation. What was coming up as you were talking about that is that it tends to be rather than being quite so widespread, right? Um the adage like if your barber is telling you to buy into a stock, then it's done. Like don't do that. Right? Like that was happening a lot at that time where everybody was invested, right? They're quote unquote everybody and speculating. Like there was more again speculation in the market. Speculation being people buying things that were very high on the risk scale. Like you really don't know what your return's going to be, but you have this idea that it's going to, maybe double or triple or quadruple, right? Like that's kind of the speculative bet. The same thing we've seen in the last couple of years, that would be like the GameStop fiasco
yep.
from a couple of years ago, right? Any of the quote unquote meme stocks where individual investors have kind of like pumped up or brought down an individual stock. That was a little, like people in the investment industry were a little freaked out by that at first, like what's happening? Is this, is there illegal stuff going on behind the scenes? For the most part, there wasn't. It was just coordination via Reddit and things like that. But
Which is illegal, by the way.
that's true. That is illegal, right? Yeah, investment front running and things like that is illegal. Um, but it again, it was like more tightly controlled. And even when it did, when we did find out more about what was happening, people did get in trouble for that. And again, it didn't like spread through the entire system of
Correct.
investment. It like stayed contained because we have tools to to corral it, maintain it, not let things like that spread through quite so quickly. Like you
Yeah.
said, the margin. Um,
But I'll even get I could credit the SEC for a lot of that containment because
mhm,
um, Robinhood is a good platform, but Robinhood was a new platform back then, and the founders of Robinhood were not exactly the greatest at compliance. I don't know if
mhm,
they knew the rules or what, but the SEC walked in and said, "We've heard, a couple of your investors have complained to us, so we're going to look at your company." And they did, and they found some deficiencies, which Robinhood, to their credit, fixed.
mhm.
And that contained, I think, a lot of what could have spread throughout the industry.
And that also that reminds me, the SEC, FINRA, these entities also didn't exist back then, or
Right.
they didn't have the regulatory capability that they
Right.
have today, the teeth, really that they do have today. And we've talked about this before, and I like to remind people of this too, that like the regulations, the reason that the financial industry um, is, as relatively safe as it is now is because we've been through these times of like it was not good. It wasn't good during the Great Depression. And, you know, even Bernie, like most recently Bernie Madoff in the early 2000s, 90s, 2000s. Um, you know, people have done things that have taken advantage of investors, and that's why regulation is put in place, is to then protect the individual investor as much as possible. That also flows through ERISA regulations that are put on place on your 401k and your 403b, right? These are very tight regulations to make sure that people aren't, your employer or investment managers aren't messing with your hard-earned and saved money. And that just didn't exist back at that time.
No, no, it didn't. And, you know, um, I think it's important for people to understand that, like you were saying, regulation's there for a reason. Um, Not all regulation, I mean, regulation needs to grow with the times and the
Hmm.
technology.
Absolutely.
And every once in a while we have this great leap forward in regulation, but it's always in response to a crisis. Okay. So for example, the Great Recession could have been a depression if the Federal Reserve and the US government didn't have the tools in place to deal with it. But fortunately they did.
Hmm.
Now, do I think they dealt with it well? Not really. I think they could have done a far better job. But again, those are for future policymakers to learn those lessons and to better it.
Hmm.
Um, I think one of the things that, you know, I think one of the things coming out of that Great Recession, which was so important, is the fact that we had allowed banks to become a little too aggressive in their balance sheets. Um, and and I think it also highlighted the law of unintended consequences when Freddie Mae and Fannie Mae and Freddie Mac tried to get people into houses to live the American dream, um, and unfortunately sent a perverse message that we even want people who can't afford houses to get into homes. And so, kind of the mortgage brokerage, mortgage banking industry kind of took off with that a little bit.
Right.
But at the beginning of it was the government mortgage entities saying we want more subprime mortgages from you guys. And so, be careful what you wish for because the mortgage industry sent them a lot of them. And the problem is then it became fraudulent in nature. And so again, now we have a lot of regulations that will catch that stuff. So
Hmm.
there's always but again, I think that's more of a one-off every once in a while. I think it's always a risk, but I don't think it's a very high probability of a risk. In fact, I think it's extraordinarily low.
Well, and to your point, also, I wasn't there at the time, but the bank. So, right out of college, my very first job was at a local bank in the town that I went to college in Flagstaff, and in 2007, my husband and I moved to Cincinnati so that he could go to grad school, and that's when I started working at the broker dealer that I worked at for a long time. But that bank that I worked at, a little over a year, like a year and a half out of college, 2007, moved to Cincinnati. Things are going okay. 2008, 2009, things are not going okay, right? Like we hit the Great Recession. That bank, their balance sheet wasn't healthy enough. They literally experienced, like my coworkers that I still knew, experienced that the FDA, going up to the doors in the morning to start their shift and they're locked. They can't get in because the FDIC has come in and they took over the bank and literally they turn it around so quickly. They found another buyer, they found another bank to take over everything. So the depositors that then came and knocked on the door later that day, well, it's not bank A anymore, now it's bank B. Everything's fine, you can still take out your money. That was literally how quick it was, how fast it happened. And to imagine those same, the business owners that I worked with, the sweet old ladies that came, and talked to me every day at my window, to imagine them having to like go up and be like, it's gone, it's all gone. Like that's crazy to me. Like, I just can't even imagine that because
Welcome to the 1920s.
I know that's so insane where now it's like literally a 24-hour or less turnaround to where it's not First State Bank anymore, it's SunTrust. And now welcome to the SunTrust family. Like, okay, I guess that's what's
Well, and that's
happening.
and that and that kind of FDIC kind of investment banking mergers and acquisition analysts that function that they play now. That was learned during the bust of the Resolution Trust. If you remember the RTC being put into place, that's a lot of what they learned during the RTC
Is that the late
was,
70s, 80s?
yep, late 70s and 80s was, okay, we have a lot of these savings and loans that are going under and we can't afford it all. So they would start approaching banks and giving them a pretty good discount on these assets to buy these operations and fix them. And so that's where that came out of. So again, every crisis, every problem, um, regulators and policymakers learn. We as investors learn. Um, Consumers, households, businesses learn. And that's kind of what an economy is. It's a ecology where everything adapts to the events that are occurring around it and in it. And that's one thing I want to give people the confidence is that the economy is a very resilient uh, ecosystem. And it's something that you want to continue to participate in and you want to make sure you have an eye on the risks, but don't be so overcome with the fear of the risks that you don't participate.
Right.
Um, the US is still the greatest country on earth to make your way and to do whatever you want in terms of your career, your family, all of those things. We have the freedom to do that. Other countries don't. And so make sure that you are participating in the US economy because you can kind of write your own ticket. Um, you want to be a CEO? Go for it. You can be a CEO. You want to be a guy who, you know, doesn't become a CEO, wants to be just a baseline mailroom worker? Great. You can do that. That's up to you. It's your choice. You can choose. So don't don't get so worried about what could happen because 85% of the things that you worry about will never take place.
Hmm. Yeah. And that taking that agency, that personal agency of, that I think that's also what we talk to our clients about very often, is like what steps do you want to take? What are the things that you can actively, proactively do, versus just being passive and at the quote unquote, at the mercy of whatever the stock market is doing or whatever your employer is doing. Um, Being able to the people that are able to move through the economy most efficiently, most prosperously, are the ones that take that sense of like, I can choose what I do next the most seriously and really take that to heart and make the choices that are available. It doesn't mean you have every choice available to you right in front of you. And I think that's a little piece of it as well, is that it's like, well, sure, how would I even ever be, a CEO of my own company? Well, you don't start out as the CEO of a 5, 10, 50, $100 million company. You start out with an idea and a dream, and you start that way, right? And you take the step that is in front of you right now, and that next step, and that next step, and that next step. And you, with the trajectory of, I want this to grow into something that will have an impact later on. Um, but yeah, consistency, perseverance, having your eye on some sort of goal for your life. Like those are the pieces that I talk to my clients about a lot. And what step are you on right now? What's the thing that we need to do today, this month? That's how it goes.
Perfect.
With that, it's like, I really appreciate this exploration. I'll do a little plug too. One of the podcasts that my kids absolutely love is called American History Tellers. Um, and they do such a great job of really like fleshing out a lot of the a lot of different parts of history, whether it was the Civil War or, right now we're listening to one about the Progressive era where, Teddy Roosevelt was the president and women's suffrage was, like on the verge of um, finishing up their cycle, and World War One, World War Two, all kinds of different. The Civil War was a huge one. Um, but they do a really good job. They did one on the Gilded Age too, which was super interesting,
Hmm.
which has also a lot of echoes to what we're experiencing now without minus the regulation, right? So this again, like we are experiencing echoes and rhymes from history, but the way that we've built consumer protections in place, that's really, really, really important. Um, and I agree with you too that sometimes regulation can go a little too far. Sometimes it can be, it can um, put limits on an industry where we need to like reimagine and relook at things. But for the most part, regulations are there to protect people. And that's the intention. And that's how we want to, if we look at it from a lens of we want to protect people and we want to let businesses grow, how can we do both? That's what we're trying. I feel like that's what we're trying to do and what we've been like working towards over the last 100 years.
Yes, I agree with that. I think it's threading a needle, right?
Hmm.
You gotta get it right. You can't go too far on one side or the other. And from time to time, we swing from one side to the other until we learn a lesson, and then we kind of go back towards the middle again. And so, again, I would say have faith, everyone. Just, things aren't dire, but just keep plugging away. And while the probability of a Great Depression is extraordinarily low, um, the probability of a really prosperous future is also it's it's a pretty good probability in the future. So I want you to walk forward with that, having a positive attitude about it, not worrying about the little, the low probability events that could happen in the future.
Yeah, it's such a good one. So as always, we would love to hear your questions. We'd love to get your comments and your feedback. And if this was interesting to you, if you enjoyed this little format of like a little bit more history lesson and how we got where we are, if there's anything else that is super interesting or that you've heard and you're like, well, what about if you want to hear more about quantitative easing and why that mattered, or more about the Great Recession, or more about the dot-com bubble burst, or like anything that you would like to hear more about, let us know. We'll put something together for you. So we are, let's see, what's this week? Next week should be normal again. My family is in the process of getting ready to make a really big move. So we are going to, Brad and I are going to be on schedule as much as we can over the next 3 weeks, but we might miss a week here or there, just to let everyone know. So I appreciate the grace as we make a sizable transition as a family. But Brad, thank you so much for being here today. Thank you for all of your research and knowledge about all of this. I really appreciate you.
Appreciate you. Thanks.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.